makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump has been threatening them for months, and now its sweeping new tariffs are officially in effect. Taken together, they will push the average U.S. tariff rate to 15.2%. That's according to Bloomberg Economics. But Trump is still surprising markets, announcing plans for a 100% tariff on chip imports while exempting companies moving production back to the U.S.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge.
Well, in a moment, we'll unpack the economic impact with Jari Stehn from Goldman Sachs. Now, let's dig into some of the detail. We're joined by Jill Deeses in Hong Kong and Ross Matheson, our EMEA News Director. Ross, we're also really focused. We'll get into tariffs in a second, but we're very focused on this possible meeting between Vladimir Putin and Donald Trump. And the Kremlin, according to IFX, says that actually the meeting will take place as agreed in the next couple of days. It's not market moving, but it actually changes quite a lot for Europe.
Well, it could be very significant if this meeting does go ahead. We don't know the location, we don't know any of the terms, we don't know what they will have agreed before they sit down, because for both Vladimir Putin and Donald Trump to go into a meeting, they want to have a clear sense of what they're going in to get and how they're going to get it, because the risk is high for both of them, particularly for Donald Trump, in sitting down, face to face with the Russian president. The question is, are these threats of hitting Russian oil being sold to India, to China, to elsewhere, secondary sanctions, are they the thing that's putting the squeeze on Vladimir Putin? Is he showing that Trump is exasperated with Vladimir Putin? Is that now coming through? And in turn, what does Vladimir Putin offer? Is it he'll stop his airstrikes on Ukraine? Is there going to be even talk around territory at this point? So, yeah, high-risk meeting. Let's see if it actually does happen and where it happens. And then, of course, what are going to be the parameters going in and coming out?
Yeah, and of course, all this is happening in the middle of these, tariffs going up. Jill, we had this other surprise from President Trump, because he basically says that there's a likely impact of 100% tariffs on U.S. chip imports unless he's carving it out, you're investing a lot of money in the United States.
Well, Francine, I think that unless is pretty big. I mean, the way that, we've heard from Donald Trump, and we just played a clip a few moments ago, kind of talking about how he's saying, well, if you're building or investing in the United States, then you could, conceivably be exempt from this. I mean, again, we haven't seen anything written down in the form of a white paper or anything like that, but that would conceivably cover, all of the major chip makers. I mean, think about it this way, Francine. So, for a lot of, semiconductor companies, chip designers and such, they're working with companies like Taiwan's TSMC, South Korea's Samsung, these companies that actually have the fabrication plants that are capable of, creating these chips that these companies are designing. And both of those companies have plants in the United States. We know that, TSMC has spent years building fabrication plants in Arizona. We also have, Samsung's building plants in Texas. So, you do have this capability that's already in the United States. Now, of course, not all the world's global demand and capacity can be built out of, just these, U.S.-based plants. But if you're reading Trump at, this most generous sort of broad interpretation of what he's saying here, then I guess, that does qualify for exemptions if you've got these companies that are already building in the United States or that continue to build in the United States. So I do think that, again, as with a lot of things, Trump, this classic idea of, you're listening to what he's saying. A lot of this is still a bit nebulous. Some of it is a little bit vague. But again, I think the reaction that you're seeing today is based on the fact that, reading that interpretation of what he's saying in the White House, it does seem like a lot of places, a lot of companies are going to be exempt.
Yeah, and Roz, I mean, to Jill's very good point, the thing is that every time there's an announcement like this, it kind of scrambles, trading partners and companies to try to make sense of what the president wants, of the threat out there. And then, Trump also doubling tariffs on India. So what do we read into that?
Well, it's interesting, again, to see how quickly the relationship with India seems to be turning, because, of course, there's a strong personal relationship between Narendra Modi and Donald Trump. And so what's behind that? I mean, obviously, he's singling out India over Russian energy. He's not going for China, meantime, although China imports a lot of energy from Russia, primarily because China has that key leverage in rare earths. It has something that Donald Trump very much wants, and he really wants to keep that trade truce going with China, and he perhaps wants that sit-down meeting with Xi Jinping at some point. So what is it that's getting up his nose really on India? And where did this come from? Does it track back perhaps to the tensions that we saw between India and Pakistan? I mean, India was quite annoyed at Donald Trump for just declaring a ceasefire and putting India and Pakistan, in India's eyes, on the same footing as kind of semi-equal partners. Does it track back to that? Is it something else? But for whatever reason, Donald Trump has decided that India is the one in the crosshairs. And the question for India is, how do you respond to that? We're seeing that India actually is like seemingly digging in here. They're saying, you know, Narendra Modi is saying, I'm protecting farmers, I'm protecting industry here. We are going to buy local. We're going to buy goods that are made by, he said, the sweat of Indian people. And he's, you know, digging in. So is there a way to get this to diffuse between them? It's hard to see. Maybe it's a direct phone call between the two of them again and the two of them sorting it out.
Yeah, and Jill, I mean, to that very good point, I mean, it was also, I thought it was quite bizarre actually having Tim Cook, the chief executive of Apple, in the White House with Trump declaring that Apple is coming home with this new investment. I mean, can we export more? I mean, can more companies do the same? And how did you read the room yesterday?
Yeah, I think, Francine, it's become very clear to a lot of these companies that sort of, bending the knee, kissing the ring, this idea of placating Donald Trump by, making this, appearance at the White House and pledging these types of commitments does seem to ingratiate them with the U.S. president. I mean, obviously this big announcement from Apple yesterday, you've got a $100 billion US dollar commitment that they're talking about in terms of building up domestic manufacturing, adding to an existing plan for $500 billion worth of investment. Obviously, we have to see what that ultimately looks like, long term. I mean, over the course of Donald Trump's, presidency, his second term in the White House so far, we've heard plenty of massive commitments from all kinds of companies that have said this. I think, what that actually looks like once, a lot of these plants are built and what, the supply lines look like really kind of remains to be seen. But this is a playbook that we've seen before. I mean, we saw plenty of, major tech executives show up at Trump's inauguration. We've seen them, take meetings with Trump in the White House. We've seen even, international companies, look at SoftBank and Masasan, talking about investments earlier this year with Trump. So I think if you're any of these companies and you're trying to think of ways that you really sort of play the rule book here with Donald Trump, a lot of it ultimately comes down to, how do you end up ingratiating yourself with Donald Trump? You make these big flashy announcements, maybe you show up at the White House, you take these meetings, and that seems to be the strategy, that a lot of companies are really kind of relying on to sort of navigate their way through otherwise, a somewhat unpredictable administration.
Yeah, interesting to see that it works actually if you're chief executive, maybe less so if you're head of state, to Roz's good point about Narendra Modi of India, and then also Switzerland now with the highest tariffs amongst the Western world. Ros Matheson and Jill Deeses, thank you as ever for joining us. Now joining us to talk about the markets, Yari Stehn, chief European economist at Goldman Sachs. Yari, we'll get onto the Bank of England, we'll get onto Europe in a second, but we did have, I think, 3 Fed policymakers yesterday voice concern about the U.S. labor market. Does that change your house view on the Fed because of the economy and therefore potentially also what it means for Europe?
It doesn't actually. We are expecting the Fed to cut in September, in October and December. That's been our forecast for some time because the US economy is slowing down. And so we saw the payroll numbers, the latest, as supportive of that. Of course, the main event there was really the big downward revisions, and those tend to happen around turning points in the economy. So we do think that was an important signal. And the recent Fed commentary, I think, is consistent with the idea that the FOMC wants to cut rates here to support the economy. And so we think we're on track for a cut in September.
Yeah, this is what Mary Daly had to say, actually, about the labor market. Here she is.
Once the labor market stumbles, it falls. And it falls quickly, and it falls hard. So you don't want to get into that situation. So all this means, as you put it together, that I think we'll likely need to adjust the policy rate sometime in the coming months.
You're expecting a cut in September, or do you also worry about inflation going up because of these tariffs?
We do think inflation will go up, but we think those are going to be temporary effects. They're really price level effects rather than inflation effects. We think they will be sizable, but we also think the FOMC is inclined to look through that to a large extent and focus on the labor market, because that is really what is helping you to predict where inflation will settle once these price level effects from the tariffs wash out. And so, that's why, despite the prospects of inflation moving up in coming months, we think they will cut really with an eye to the labor market and an eye to the slowing economy.
Well, let's also talk, Yuri, about the Bank of England. It's today. Of course, markets are expecting a cut, a quarterly cut. Market thinks rates will settle around 3.5%. I mean, that's 50 basis points away if we get that cut today. Do you think we're starting to approach the end of the cutting cycle?
I don't think so. I think there's still more to do for the Bank of England. As you say, we'll get 25 basis points today. I think we will also get a renewed pledge for a gradual decline in rates. Of course, they're going to also say that they want to be careful, which I think basically means that they're attentive both to higher inflation, but also to weakening labor market. They can adjust the pace as we go along. But ultimately, we do think the labor market is weakening. We are seeing that pay growth is now slowing. And we also expect fairly subdued growth for the UK over the next year or so. Rates are still high at current levels. And so we do think these cuts will continue. I think for now, we will stay on a quarterly cutting pace, given that there are still questions around inflation, and inflation has surprised to the upside in recent months. But ultimately, we think rates will fall more than what's currently priced. So we have them falling to 3%. Below the 3.5% price, which we think would be a more neutral and more normal level of rates for the UK.
And Yuri, how are you expecting the split on the MPC today?
Yeah, that's of course always a very hard one to guess. I think the safe guess is that it's going to be a three-way split, that you're going to get support for 25, support for 50, and support for a hold. Our best guess would be that we get 6 MPC members for 25 basis points, that we get 1 for 50, that would be Swati Dhingra, and we get 2 for a hold, which would be, in our view, Hill and Mann. But again, pretty hard to guess. And I think, we could get a second dissent for 50, Taylor, for example, but there could also be some shifts on the other end of the distribution. But I think, bottom line is going to be that I think there's going to be a good amount of support from the center of the MPC for the cut today.
How worried are you about the labor market? And, we've had an adjustment in April because of Nick's, the minimum wage increase. Are we past the worst?
I think we are slowing. I think we continue to slow. I don't think we're falling off a cliff in terms of employment. The difficulty is, of course, the data. We have data quality issues in the UK. So what we tend to do is two things. One, we average across different labor market indicators that include the usual LFS employment data, also the payee payroll data, but then also surveys. And what we're finding now is basically that the labor market has been slightly contracting over the last few months. And so I think the incoming data supporting that. The other indicator we look at is the vacancy to unemployment ratio. This is one that the MPC has emphasized, which gives you a sense of slack in the labor market. And here we continue to see significant drops in vacancies relative to unemployment. That's both because vacancies are going down and because the unemployment rate is going up. So I think if you cut through the noise, we are seeing a significant slowing in the labor market. We think that will continue, but it's not the case that we're seeing a very sharp downturn at this point in the labor market. It's really more a steady deterioration that we think will continue.
Right. Yuri, is it fair to say that it's actually just it feels harder to set policy, interest rate policy for the UK than it does for the Eurozone? And if you agree with that, why?
I think that's right. I think the reason is that you're getting cross currents in the data with regard to the inflation outlook. So on the one hand, the spot data continues to surprise to the upside. So, in the latest inflation report, headline inflation was higher. Headline inflation is, probably going to track close to 4% over the next few months, which is obviously too high. At the same time, the more forward-looking indications, like the labor market we've just talked about, like the growth outlook, pay growth, that is slowing. And so the tricky situation for the MPC here is that you really have to trade off this high spot data versus the weakening forward-looking data. And I think that is really the extent of disagreement on the MPC. The different members put different weight on the spot versus forward perspective. And that is harder in the UK than it is, for example, in the euro area, where inflation now is close to 2, policy is close to neutral levels. I think it's much more straightforward at this point for the ECB.
Jari, thanks so much, as always, for your great insight. Jari Stehn, there, Chief European Economist at Goldman Sachs. Now, if you're just joining us, let's recap some breaking news from a little bit earlier. Russia and the U.S. agreeing on a venue for the meeting, and together with American colleagues, they're starting to work on specific issues. They're basically saying that Russia is saying that Presidents Vladimir Putin and Donald Trump will meet for summit talks within the next few days. So that's the very latest, of course, on that possible meeting. Coming up, but we'll speak to Mario Greco, Zurich Insurance, reporting a 6% gain in profit for the first half of the year. That's next, and this is Bloomberg. Welcome back, everyone. Now, Zurich Insurance has posted a 6% gain in profit for the first half of the year as the insurer shook off losses from the California wildfires. Now, joining us now is Mario Greco. He's the chief executive of Zurich Insurance Group. But Mario, as always, thank you so much for joining us. Look, there's a lot going on in trade and tariffs and interest rates. So where do you think we are? What kind of cycle is the insurance business looking at right now?
Yeah, the markets are still very strong. The economies are growing. Inflation is subdued everywhere in the world. Investments are coming. There is a lot of construction. There is a lot of infrastructures being built. This is very supportive for our business, as our numbers show. The markets hate uncertainty. And so, in a sense, clarity is much better than any results. Clarity matters much more than the level of tariffs. And so I think, I'm confident that from now on, we will have even better markets than we experienced in these 6 months.
What does it mean for pricing and fees and premium in the insurance sector?
Yeah, the insurance landscape is very differentiated. We have some lines of business like motor, where price increases have been pretty high in the first 6 months and will remain relatively high through the end of the year. Liability is hiking strongly because of unprofitable results over the past years. And we really look forward to this continuing over the rest of the months and the next years. Property, on the other side, is softening, is reducing the growth of rates. And this is fair enough, because property had very good results for insurers over the past years. And so customers have absolutely fair right now to have reduced price increases for property. But overall, the margins are healthy. And we're very much expanding in mid-market customers, in small and medium enterprises, and in the specialty area.
So given everything that you've laid out and everything, frankly, that's going on, what's the next strategic step for Zurich? How important is M&A in this equation?
M&A for us is always an opportunity that we consider, but has to fit into our strategy, which is now to grow our mid-market portfolios and the specialty books and the small and medium enterprises, and has to be at disciplined financial conditions. If we find opportunities that fit into this, we will definitely consider. We have the financial resources, we have the capabilities, we have the interest to do it, but it must be according to what I said, to our strategic principles, and it must be financially disciplined.
How are you implementing AI, and actually are you expecting any cost saving from that then you could, if you find the right target, spend that on?
Right, that's a great question. Look, AI so far has been helping us optimizing our expense basis or the customer service. That's useful, and we're grateful to AI for that. But in a sense, it's not enough. We're looking at ways in which AI can help us revolutionize the insurance business model. Insurance is a business model that goes back in centuries, hasn't changed much. We just went from papers to computers, but we kept doing the same things. I think with AI, there is really an opportunity to rethink about the way we do the business and do it in a very different way. This is what we're really busy with these days. We continue tinkering, but the most promising development is to look at AI to completely revolutionize the business model.
Mario, could you give me a sense actually of, when you look at currencies, and it's very clear that the Swiss franc has been quite strong, and actually dollar has been weaker. Will that impact your results?
Of course it does. Currencies had quite a strong impact on our results, and so our results stand out even better given that. However, we're kind of arbitrage naturally because we invest assets in the same currency where we have the liabilities. The most concerning aspect for our investors is on our dividends. And the message that we want to give today is that we already generated the cash to pay the dividend this year. And so the dividend is safe and already here in Zurich. But of course, we will continue working for the next years.
Okay, Mario, very quickly, I mean, what's your take on the Swiss-US tariff deal?
Look, I'm confident that Switzerland will find a way to remain strongly competitive, and I'm confident that Swiss companies will continue to report the manufacturing, the industry, the pharma, very good profits. They'll find a way to do that.
Mario Greco, thank you so much, as always, for joining us. That was, of course, the Chief Executive of Zurich Insurance Group. Still ahead, the Bank of England expected to cut rates today. We'll have the details next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump's sweeping tariffs take effect in a fresh test for the global economy, while the president eyes a 100% tariff on semiconductors with carve-outs for firms investing in America. The Kremlin says Presidents Vladimir Putin and Donald Trump will meet for summit talks within the next few days. Plus, the Bank of England is set to cut rates to a two-year low as policymakers contend with a slowing economy and mounting concerns about the labor market. Now, one of Donald Trump's highest tariffs is now in effect on Switzerland after the government failed in its last-ditch effort to get the U.S. president to lower the rate. The 39% levy on exports from Swiss watches to Nespresso coffee capsules is the highest amongst developed countries and compares with just 15% on the European Union. Well, joining us now is Thomas Bohrer. He is a former Swiss ambassador to Germany and founder and managing partner of Dr. Bohrer and partner. Ambassador Bohrer, thank you so much for joining us. First of all, I mean, I don't know if it feels like diplomatic catastrophe showing up to Washington, not meeting with the president, and then coming back empty-handed.
No, I wouldn't call it like that. It's clear that the United States is a superpower, Switzerland is a medium power, and we have to understand that President Trump is not the normal politician. He sees himself as a transactional leader, and diplomatic behavior is not one of his priorities. And, you know, Switzerland, I can tell you how it will play out. Switzerland will come up in the next hours, hopefully, with a strategic action plan, how to tackle the huge trade balance of 40 billion.
Right.
Because this trade balance is the only thing which interests President Trump. Other facts he is not interested in. So we have to tackle this issue.
Yeah, but first of all, I mean, look, President Sutter seems to have refused to budge before Trump, right? This was ahead of the announcement of the tariffs. Was that a failure of a strategy, or did she do the right thing?
The Swiss government thought that the United States are still working in normal diplomatic terms. That means an agreement negotiated on the level of ministers will afterwards not anymore be changed by the president. That was the case before President Trump took office. That was the case with the European Union and others. You can rely on the commitment of ministers of commerce or the USTR. But as I said, for President Trump, everything is negotiable till he has signed the deal.
Do you think Switzerland will implement countermeasures to the tariffs?
No, we will not implement countermeasure. We will come up with a strategic action plan negotiated by the Swiss government and the private sector and really tackle that 40 billion trade deficit. We will tackle the issue of the gold smelters, which adds 20 billion to that trade deficit. I think we should export these smelters to the United States and make the United States the biggest gold smelter in the world. We have to tackle the issue of the pharmaceutical exports we have. And Novartis Roche has already promised that they will invest billions in the United States and make the United States a huge pharma producer. By that, we will reduce our trade deficit again. And then we should, and we will, like the European Union, make promises that Switzerland will buy over the next 2, 3, 4 years. Right. $billions of American goods, LNG, arms, probably also beef. That's going to be the strategic plan the Swiss government will reveal, hopefully this afternoon already.
So, Ambassador, I mean, the strategic plan is basically giving in to what President Trump wants 100%, if not 120%. There's no strategy in getting closer to the EU or getting closer to the Far East. It's basically trying to work with the president, giving what he wants, put money in the U.S. to alleviate the tariffs so that he doesn't get madder?
The United States is our most important trade partner. And if we do not want to have industrial recession, we have to come to terms with President Trump. That does not mean that we do not come up with new trade deals with other areas of the world. I think that's one part where Switzerland is very strong. We have a free trade agreement with China. We have a trade agreement with Latin America just now negotiated, with India, with Indonesia. And that is the way we have to continue. Yeah. And of course, also, we have to come to terms with our trade relation with the European Union. So do A and B and not only find an agreement with the United States.
Does it show, do you think this is a dark hour for Switzerland? And actually, does it really show the limits of openness and global integration that has really been the defining factor of Switzerland over the last 30 years?
No, it's not a dark hour. It's one of many challenges. And we overcame this kind of challenges over the last decades. very often. Remember 2007, 2008, the huge euro shock, where in one day the euro became much weaker to the Swiss franc. That was a heavy burden on our industry. The corona shock, now the failing or the very weak dollar, these trade negotiations. Switzerland over the last decades has always proved that they overcome these challenges and we come out stronger if we take the right measures.
All right, Thomas Bohr, thanks so much for joining us. He is a former Swiss ambassador to Germany, founder, managing partner, Dr. Bohr and partner. Now back to a developing story out of Russia now, with the Kremlin confirming that President Donald Trump will meet with President Vladimir Putin in the next few days. It follows comments from Trump about potential talks between the leaders, as well as Ukraine's Vladimir Zelensky.
We had some very good talks with President Putin today. And there's a very good chance that we could be ending the end of that road. That road was long and continues to be long, but there's a good chance that there will be a meeting very soon.
How close do you think you are to a deal?
Excuse me?
How close do you think you are to some kind of deal?
Well, I don't want to say. I've been disappointed before.
Now, the effort to convene a meeting came hours after Putin hosted U.S. Special Envoy Steve Witkoff for 3 hours of discussions in Moscow. For more, we're joined by Tony Halpin, who leads our Russia coverage. Tony, thank you for joining us. So, Trump-Putin meeting, what can we expect? What needs to happen before the two actually sit down?
Yes, the Kremlin said this morning that they're working out the details with the American side, that they've agreed that there'll be a meeting within the next few days. He said they're working on next week. They've decided on a venue, though he hasn't disclosed that yet. And he said that Witkoff raised the idea of a trilateral meeting involving not only Putin, Trump, but also Ukrainian President Zelensky, but that Russia hadn't really responded on that question, that they're focused on the bilateral talks between Putin and Trump. Clearly, what we yet don't know is whether or not that Russia will declare a ceasefire before that meeting takes place.
So, Tony, are we any closer to a ceasefire on this war? Does any of that need to happen before the two leaders sit down?
Well, I think certainly from Ukraine and Europe's point of view that they want to see a ceasefire in place before any sort of meeting takes place with Putin to try and reach a longer-term settlement. The US, too, has been pushing for a ceasefire, and that was part of Trump's deadline, the Friday deadline tomorrow, for imposing secondary tariffs on purchases of Russian oil that Putin had to agree by that date for a truce. We don't yet see from the Kremlin that there is a willingness by Putin to stop the fighting, but clearly, as they've indicated, there's a plan for a meeting within the next few days, and it would be quite surprising if there wasn't pressure on the Kremlin to agree to at least a short-term truce while that meeting took place.
Tony, will President Zelensky be there? How much of a difference does it matter on the global stage if it's a two-way meeting or a three-way meeting?
We don't yet know. I think the original proposal was that Trump would meet with Putin and then meet with Zelensky, and potentially there would be a three-way meeting involving all three leaders if those talks went well. We're waiting to see whether or not, in fact, President Zelensky is invited to this meeting and indeed where the meeting will take place next week.
Tony, thanks so much. Tony Halpin there with the very latest on Russia and the U.S. Now, shipping giant Maersk has raised its financial outlook for this year, saying demand outside North America is resilient despite concerns over global trade. The chief executive, Vincent Cleric, says customers will start to alter supply chains to adjust to Trump's tariffs.
What is really important for us right now is to see where this is landing with China. This is something that has yet to get fleshed out, and once we have this in place, then I think we will see uncertainty ebb, and we will start to see customers actually understanding what they need to do now to adjust their supply chain to what is a structurally different trading environment given the tariff levels and the different deals that have been put in place.
Well, let's bring in Bloomberg's Oliver Kirk now with the very latest. Ollie, look, Maersk was pretty upbeat about the outlook.
I mean, you know, the trade war technically started today at midnight, and yet this is what we hear from the biggest shipper across the world. Very upbeat outlook, raising even their outlook in terms of what they see coming down later in the year. Very bullish on China as well, saying that, yes, there is a diminishing of trade with the United States, but actually building on this macro narrative that we hear from a lot of European officials that actually you need to expand trade elsewhere in the rest of the world, and that is exactly what Maersk was seeing in their numbers a little bit earlier today. So I think that is sort of very interesting, particularly since you think about kind of how important trade is now the main sort of policy plank in dealing with every geopolitical issue for the United States, and potentially longer term, United States maybe isn't the only game in town.
Yeah, and I wonder, I mean, you had to redraw the map anyway, right,
Yeah.
if you're keeping them at home or changing the supply chains. What about Siemens?
Yeah, Siemens, another interesting one. I mean, this is a business that has really three main categories. There's the mobility, which is, for example, train building, and it actually was the big winner. Massive order from Egypt, so that really sort of boosted the books. Where we've seen continued weakness from Siemens is this idea of digital industries. Factory automation is one of the things that they have seen sort of not really rebounded. That is in part due to China. Though I did ask him about basically, are you seeing now a push for factories being built in the United States? You need to automate those. Siemens is going to be a part of that. He says he's beginning to see the beginnings of that within the United States, though not the full impact of it. I think also what was interesting is his view on the tariffs. He has said in the past, a bad deal, an okay deal is better than no deal at all because it brings certainty. Have a listen to what he had to say this morning.
Talking about the uncertainties, this is really a topic, and you cannot have this kind of worms open for a longer time. I think everybody knows that. So we hope that this deal now between the United States and Europe is the deal which is set now, that they execute now accordingly, and companies can start planning and also release investments which they hold back.
So, Francine, hoping that the deal is the deal as ever, like so many policymakers, like so many CEOs, the last part of their business is smart infrastructure. Part of what that does is feed data centers and is going to be fed by all of that. That, again, another bullish outlook for Siemens. So a couple tailwinds, despite the fact you had a little disappointment from digital industries.
There you go. Firing on all cylinder for this Thursday morning. Ollie, thanks so much. Oliver Crook there with the very latest on Maersk and Siemens. Coming up, Trump's tariff shake-up could be drowning out appetites for Europe's real estate markets. Well, we'll speak to Richard Bloxam, Chief Executive Capital Markets at JLL. This is Bloomberg. Well, the Bank of England set to cut interest rates today to the lowest level in 2 years as policymakers contend with the slowing economy and a jobs market rattled by higher taxes. Our UK correspondent Lizzie Burden joins us now from outside the Bank of England. So, Lizzie, what surprises could there be today?
Well, Francine, as you say, economists and markets expecting this quarter point cut to 4%. So that'd be lower than the Fed's rate, notably. But what's maybe surprising about that is that you've got inflation at a 17-month high. But the reason that they'd still be cutting is that you've had these back-to-back contractions in the economy and the slowdown in hiring, both attributable to this rise in the payroll tax and the rise in the minimum wage, hence why they would still cut. And the governor himself has said that this rise in inflation is only temporary, although that's obviously not a unanimously held view on the Monetary Policy Committee. But it's because of that stagflationary backdrop that economists are expecting a three-way vote split today. So 2 dissenters for a half-point cut, 2 dissenters for a hold, and the rest voting for a 25 basis point cut. It would be the same as 3 months ago when they voted to cut. But the real surprise could come from the guidance, because if you see them dropping the description of the rate path ahead as gradual, that would be interpreted that maybe they want to veer off this quarterly cadence of quarter point cuts.
And could the Bank of England, Lizzie, actually hint at slowing active gilt sales given the strain on these long-end yields?
Yeah, I mean, the real focus on this, because they're making this strategic decision in September, but of course today's the day when they have the press conference. There isn't one scheduled for that meeting. And of course there's been all this speculation about whether they will tweak the pace of gilt sales, because as you say, you've had this rise in long-end gilt yields, particularly the 30-year, up to levels that we've not really seen since the 1990s. So the question is, do they slow the pace of active gilt sales, or do they skew it towards the short end of the curve. And when the Bank of England surveyed market participants, overall the expectation was that the runoff overall would be slowed from £100 billion a year to £75 billion a year. But whatever they do, if they mention the long end of the curve, that is going to be seen as a hint that that tweak to the strategy is coming in September. And maybe this is more what's going to move the gilt market today than the actual decision itself.
Lizzie, thanks so much. Lizzie Burton there outside the Bank of England. We'll, of course, bring you that decision at 12 p.m. London time. For viewers in the UK, we'll have full coverage of Governor Bailey's news conference and a special broadcast starting at 12:15 p.m. You can also watch that live on the terminal and on YouTube. We'll bring you also a conversation with Governor Bailey after 4 p.m. UK time. Now, President Donald Trump's sweeping tariffs threats have put a pin in what many hoped would be a year of recovery for European real estate markets. Now, according to data from MSCI, commercial property sales are down some 10% by value in the second quarter and down 7% in the first half of the year. Well, joining us now is Richard Bloxam, Chief Executive of Capital Markets at JLL. Richard, thank you so much for joining us. First of all, how have a lot of the tariffs impacted appetite for some of the sectors that previously were wonderful or much loved, such as logistics and living?
There really has been relatively little impact overall on the tariffs. I think largely investors have seen through a little bit of the noise. So I think we have a very strong depth of equity available to invest in the real estate markets, as well as probably at all-time highs availability of debt across multiple lenders to the industry. So I would say that it gave pause after the tariff announcements by the Trump administration. But most investors have been seeing through that.
So where do real estate investors want to be right now? What kind of assets and what kind of countries?
Well, globally, we've seen significant uptick in investment activity, 179 billion traded in the second quarter globally. And that's 14% up year on year, 21% for the first half of the year. The most sought-after asset classes, offices, have increased significantly in the first half, 38% in the second quarter. And in countries such as the UK, that's been up to a 75% increase in activity. And that's largely driven by investors feeling confident that occupier markets are becoming more resilient. And frankly, a limited supply. We're at all-time lows across the United States in groundbreaking, and Europe is at a 10-year low in groundbreaking for new office developments. So office occupiers are having to be a little bit earlier in their planning for new locations and a bit more willing to go to locations that are not always prime. But there's robust appetite across all the asset classes.
So, Richard, give me a sense. I mean, data from MSCI show that in Europe, deals, for example, from U.S. headquartered investors dropped some 29% year on year for the first half of 2025. Does that increase in the second half, or does it get worse?
Look, I think U.S. investors have been very focused on the opportunity in the United States. The beginning of the year, there was strong appetite and forecast for GDP growth. So a lot of U.S. domiciled investors have been focused on their domestic market. But there have been announcements by a number of the big private equity players that they're going to be investing considerably in Europe. And I think infused by the level of response from Europe to the changing trading dynamics and maybe an environment where there's a little bit less regulation, a little bit more emphasis on economic growth.
Will there be less regulation?
I don't know whether there'll be less regulation, but certainly what we're hearing from policymakers is that there's an intent to make it easier to do business.
Richard, what's been the most surprising thing that you've seen in your industry over the last 2 years?
I think what's been very encouraging is quite how quickly the retail investment sector, shopping centres, shopping malls, strip malls, power centres, high street has recovered. And pretty much everything has been thrown at that industry over the last 15 years with the revolution in online retailing to COVID and then the post-COVID economic malaise. And so what you're seeing is investors showing real confidence that that industry has now, that sector has bottomed out, and that they feel confident there's now some rental growth. There's very little vacancy in retail across the world. And I think if you'd asked me 3 years ago whether we'd see that to recovery, I'd have been a little bit circumspect.
All right, Richard, thanks so much. Richard Bloxam, their Chief Executive of Capital Markets at JLL. Now, Siemens revenue on orders rose on robust demand for rail products, which helped offset a sharp decline in the software business. Oliver Crook spoke to the Chief Executive, Roland Busch, earlier and asked him if there will be a turnaround in the foreseeable future.
So I wouldn't call it a turnaround compared to what was happening in the past, this kind of recycle recovery. I always said I expect the Chinese market to come back gradually, and that's what we see. We see semiconductor business, for example, coming back, the automotive business having a slight increase. So they're coming back. Chinese government works on cleaning out the real estate problems on the one side, investing in high-tech manufacturing in order to drive productivity in a competitive environment. They're investing also in green technologies. So therefore, that's everything what they do now is tailwind for us, because we are the incumbent in automation. We drive digitalization in this country as well, but also a strong foothold on electrification. That helps the market. And according to our expectations, would come back, but gradually.
Mm-hmm. And if the Trump administration is to be believed, there are literally trillions and trillions of dollars that are coming into the United States in order to build up manufacturing capacity that should favor, theoretically, digital industries. Have you seen any sign of that in terms of any kind of efforts from other companies that you might be involved in? And do you really take that number at face value?
So we see some pickup there also from order intake in the United States for the automation business, but also revenue. It's too early to say. Again, nobody was investing until the tariffs somehow settled. So we see, I mean, you might have learned that Audi is thinking about building a new production site in the United States, the first one. So it will benefit digital industries and automation in particular. Why? If you really relocate manufacturing to the United States in a market which has high labor cost, and if you get labor at all or trained labor, the best thing what you would do is make it as automated and as digital as possible, base it on a digital twin with digital threads, and there Siemens technology comes in. So we are market leader from that perspective. We can help every of our customers to really run a manufacturing site highly automated. That's what you want to do if you invest in the United States, and Siemens is here to help.
Well, that was the Siemens Chief Executive Officer, Roland Busch. Now, a couple of things that we need to look out for. The U.S. chip stocks look pre-market. These are some of the winners and losers. Again, we had quite a lot of news coming from President Trump. President Trump eyeing some 100% tariffs on chips, but at the same time, he said yesterday that he would be exempting companies that move production back to the U.S. Now, President Trump did announce these intentions along the Apple Chief Executive, Tim Cook, who announced plans to invest an additional $100 billion in domestic manufacturing. Up next, Bloomberg Brief. A lot of the focus will also not only be on chips, but of course on these tariffs overall. Look, he said, Donald Trump, that companies that demonstrate a commitment to building in the U.S., such as Apple, will be exempt from tariffs on chips. The question is, what does that mean? How do you quantify that? A lot of global companies around the world will try and figure exactly if they are exempt, how, and how to prove it. This is Bloomberg.